So kind of summarizing everything from an economic standpoint, um, just showing our U.S. grid model on the x-axis, we're showing the 3-month, the trailing 3-year z-score, the 3-month delta on CPI, and on the y-axis, we're showing the trailing 3-year z-score of the 3-month delta on the OECD Composite Leading Index time series. That's the measure we find to be the most reliable measure for back testing and understanding asset market dispersion in the economy. So we anchor on that. It's also updated pretty consistently and robustly. And it's also a monthly time series, so we like that much more than studying the GDP reprints. For a variety of reasons, all those reasons I just highlighted. But anyway, the one thing I'll call out is that it matters the speed of the change. And not only does what grid regime you wind up in matters from an expected return, volatility, covariance, percent positive ratio standpoint, but also how far into the regime matters. And as you can see, once you kind of get into the summertime, particularly July, August, September through all these months, that's when the pace of growth, the pace of economic deterioration should really start to pick up to the downside. And that pace picking up to the downside has significant implications. I mean, the difference between where we are in May in terms of slowing, slowing from we'll be in in May in inflation. Again, I'm just showing the z-scores on the chart, so don't get confused by where the locations of the dots are. But that's a very modest slowing, and historically, you've only seen something like, let's call it +5 to -5 from an expected return perspective from the S&P 500. When you're talking about a 0 sigma delta growth slowdown, or even something that looks like a 1 sigma delta that goes all the way down to something that looks like -30 annualized S&P 500 returns, when you get into kind of the -2 sigma delta, which is where I think we're headed. Now, I think that's where the model is suggesting we're headed by the time we get into the summertime. So be aware of that. I do believe the markets, the economy and the markets are going to force the Fed to pivot dovishly, but we certainly think from this particular price in the S&P, this particular price across a lot of different risk assets, these aren't the prices you're going to see the Fed pivot dovish. It's probably got to get a lot worse from here. Just one thing I'd call out, just from a growth and inflation signaling perspective. So as you can see, the pace of growth really starts to pick up to the downside once we get into the summertime, and that should be persistent. In fact, if you look at it kind of on a 1 year forward basis, we actually might even, just from a recession signaling standpoint, the earliest we were ever going to be able to determine whether or not the U.S. economy could go into a recession was going to be Q1, Q2 of next year. That typically is like the early part of that's kind of on the earlier end on the yield curve inversion window. And as you can see, our models continue to slow through that particular time period. So it's not recession is not out of the cards. We certainly don't think it's the modal outcome at this particular juncture. But again, if the Fed continues to get incrementally hawkish as a function of inflation data now emanating through the labor market, could potentially push them into causing a recession, if you will, to get inflation back under control. And one thing that might aid and abet that process is if you look at our inflation forecast from a median perspective with just the black dotted line. And again, the black dotted lines in these charts feed into the grid sequence, the grid regime, the grid model charts that you just see on the slide. That's the median between our stationary mean reversion model, the light blue line, and the purple line is our agent-based nowcast model. And so if the inflation dynamics over the next few months kind of go the way of the purple line, where it's persistently elevated, and so even though it's going down at a very gradual pace and surprising but economist consensus and Fed consensus to the upside, although I would argue it's really no Fed consensus outside of they all recognize that they're behind the curve. That's neither here nor there. My point is, if this purple line is closer to the reality than the black line, and certainly the dotted blue line, they will be incrementally tighter relative to where they are today over the next few months. So that's something that is an upside risk as well. What would contribute to that, obviously, is the lockdowns we're seeing in China, an adverse situation from a geopolitical standpoint. Just be aware of that risk, because it certainly is in the numbers. Otherwise, it wouldn't be on the page.